The dollar's value is crumbling at an ever-accelerating rate, and that is exactly why Bitcoin exists. If you've been confused by Bitcoin's recent price moves, it's time to refocus on the big picture. Lawrence Lepard and James Lavish join me to cut through the noise and remind us all of the clear, urgent thesis behind Bitcoin. It wasn't created as a bet for short-term gains, but as a fundamental escape from the unstoppable and inevitable debasement of the US dollar. This thesis is more urgent than ever, and this conversation will reset your understanding and reveal what's really at stake. And don't miss their insights on why the next liquidity crisis will prove this thesis beyond doubt and why Bitcoin's moment is coming fast. All right, let's dive in. All right, Lawrence Lepard and James Lavish, welcome back to Bitcoin for Millennials.
Nice to be with you, Bram.
Thanks for having us, Bram. Good to be here, always.
Well, good to see you guys. Like I just told you, I felt like I had to call Uncle Larry and Uncle James to get some perspective on the market because, you know, the price is going down less than all the other big drawdowns before, by the way. And I feel the sentiment is seriously cooked, which, in my opinion, is super strange as macro-wise, the underlying thesis hasn't really changed. I think if people follow you two, it's actually accelerating. So how can we kind of think through Bitcoin lagging gold in this macro environment that you both believe is the prime context for the acceleration of Bitcoin? Maybe James, you want to...
James, you go first.
There's a lot. There's a much bigger context, broader context that we're talking about here. When you talk about the macro picture and what's going on with Bitcoin, you know, we've been trying to figure out for a few months now, a couple months now, just exactly what's going on, and it's become clear that one of the drivers of the price action in Bitcoin recently has just been OG selling. You know, you've had older coins coming out of dormancy and being dumped in the market. And you know, if you look back from what I have read, it's about 1 million coins have been sold so far this year from older wallets, and hundreds and hundreds and hundreds of thousands of them in the last 2 months. And so what is going on? What's happening? Well, there's this long-term belief of 4-year cycles. We can talk about that. I actually believe that we don't have, like, we're no longer in a 4-year cycle with Bitcoin. I think that that's broken. We'll talk about that in a minute, though. But there's this long-term belief of that, and you've got these holders who've had these coins for many years, whether it's a decade, and they bought 1,000 coins for $15,000 or whatever, and they've been, now they're worth $1 billion. That's well done. You know, I mean, I keep saying this. I don't blame them. You know, people ask, well, what are they going to buy with it? Are they going to buy stocks? Are they going to go, like, they're going to buy, bonds? What are they doing? And the answer is, they're getting liquidity likely to shore up their, not just their own family wealth, but generational wealth. And I don't blame them. They're buying, whether they're buying houses or land or businesses or, or yachts, whatever they want to do. But they're able to do that. And it's been, it surprised the market. I think, the market didn't really expect it, and they didn't expect it because if you look back in the history of Bitcoin, again, let's go to first principles here. We have basically three or four data points for Bitcoin, and that's not enough. That's not really a data set. We do point back at these cycles and blow off tops and all that, but people expected some sort of blow off top this year in 2025, especially after the euphoria of Trump being elected and the new administration who's not antagonistic on Bitcoin and crypto, like the last administration. So all these things, you have these massive positive factors, the Bitcoin ETFs, a positive, administration, positive legislation, the repeal of SAB 121. Banks are now getting into it. You see institutions buying it. You've got JP Morgan building collateral products around it. Harvard is one of their core holdings is IBIT. Like, these are all massive positive developments. But the reality is that
the bank, the Luxembourg Sovereign Wealth Fund,
yeah, all that stuff. But the reality is you have a lot of uncertainty in the market right now. The uncertainty around liquidity, and we can talk about what's going on in the repo market and bank reserves and all that stuff. But what the Fed is doing. I'll let Larry talk about the Fed. He's probably a little bit more vicious about the Fed than I am, but you've got a bunch of buffoons in there, and I'll let Larry kind of take the ball on that one. But there's a lot of uncertainty, Bram, and so you've had, I think, mentally in their mind, you had these OGs who are saying, you know what, 100,000, 125,000 doesn't matter. I'm getting out. I'm selling a portion of it, at least, maybe a third of it, a quarter, a third, a half, and some of them might have sold it all. I don't know, but it's a mental level, and it's clear because every single time that Bitcoin hit 110 and started creeping up to 120, there was massive selling, and a lot of selling from old wallets. So we're still in that, and I think that selling has begun. Selling and now you've got some of the large institutions that have been buying over the last year or two that are up huge, and they're like, you know what, that's it. If the 4-year cycle is going to play out, then I'm out. I'm gonna take my profits. I'm going to get this thing off my books. I'm going to dress it up because we're in October, November here, and you got to be doing that for institutions. They got to dress up their. They've got to window dress their portfolio for when they have their reviews, and that's all the stuff that's been going on in the background. But on top of that, you have the worries about the Fed and things that are going on there. But I'll let kind of Larry teed you up in a number of different ways there. I'll let you.
Yeah, thank you. So all these things are going on, which would buttress our thesis, and obviously the gold price is responding quite well to all those things, and that's because gold is more widely distributed, and it's always very good at sniffing out monetary debasement. And there's a very comparable period in 2018 to 2020 where gold moved first and then Bitcoin followed harder, and I think we're in one of those periods. And to me, remember, Bitcoin is kind of the perfect liquidity fire alarm, and it tells you how much liquidity there is in a system to an extent, and it soaks it up. If there's too much, it soaks it up and it goes up a lot. And by the way, when there's not enough, it's also more sensitive than gold, and it goes down more. And so to me, the fact that Bitcoin is drawing down is a very good indication that we're getting closer to what I think is going to be a trigger event that's going to lead to the big print. And I think James has written about this in his newsletters, and whether it's tomorrow or 3 months, 6 months, I can't imagine it's 12 months. It could be, but at some point in time here, well, I mean, for instance, let's just talk about the central bank, right? I mean, they've already said, and they're trying to normalize it too, Bram. It's very interesting. They've already said, hey, we're going to have to grow the balance sheet. I mean, Powell said it, Lori Logan said it, the president of the New York Fed said it. So. And they're trying to make it sound like, and it's no big deal. And by the way, it's not QE. It's not QE.
Yeah, exactly.
Last time I checked, if your balance sheet's growing, that's QE. I mean,
well, they said the same thing in 2019 with the repo crisis. This is QE, not QE. But
yeah,
the balance sheet grew and it never shrank.
Right. So and that's the way it always is. Sorry. It's kind of a one-way ratchet.
I don't. And we have battles about this on Twitter, and I don't care. I don't care if you
call it whatever you want.
Semantics. Whether you call it QE or what. It's adding liquidity into the market. Let's just say that. It's all that matters.
And not temporary, right?
And not temporary.
No, and not taking it out. And so they're very, very much trapped. And then, I think the other thing that the market's doing, the gold market anyway, and I think Bitcoin will follow, is that they're front running what they know will be a change of the guard of the Fed. I mean, Powell gets out of there in May. I mean, his last press conference, he looked really scared to me. He was very nervous in the first few minutes. He got his footing after a while, but I mean, he's got to be thinking to himself, God, just please get me out of here before this whole goddamn thing blows up.
And I agree. There was a lot of word salad, salad in that press conference, and the question and answer session. It was actually it was pretty frustrating. If you're just a regular run of the mill new investor, good luck trying to keep up with what the heck he was talking about, because he talked in circles.
Yeah, no, I completely agree. And so. And to his own, to give him some credit, I mean, he admits he's trapped. He kind of says, look, the risks on both sides of my mandate, and they're just trying to skate down the middle. But, I think eventually something will break, because that's the history of it all. There's I just gave a presentation where I just showed the parabolic growth curves of money supply and how every time that they get off of that curve, they have to come back and print. And they hopped off it in '08 and they had to print. And they hopped off it again right before COVID and they had to print. And we're right back where we were at COVID in terms of the position of the money supply compared to that parabolic growth curve. So, that doesn't mean it happens tomorrow. As I say, I think a year out is a very generous estimate. I think it's likely to happen much sooner than that. But we do know that when they do finally admit what we all believe and know, and what mathematically really is kind of a certainty, then, the markets and the world will wake up and go, oh yeah, they can't really stop printing, can they? Oh yeah, what are some things they can't print? And, gold's already smelled it, and then Bitcoin's going to take off like a rocket ship. So
Bitcoin custody is evolving, and OnRamp is leading this change with multi-institution custody, eliminating single points of failure. Instead of relying on one institution, OnRamp secures your Bitcoin in a cold storage multi-sig vault backed by 3 independent custodians, where no single party can move your funds alone, providing an unprecedented level of security. Your assets are protected by a 100 million Lloyd's of London insurance policy, with all transactions fully auditable on-chain and only executed at your direction. This means complete transparency and control over your assets at all times. Beyond custody, OnRamp provides comprehensive Bitcoin services that include trading, lending, inheritance planning, and IRAs. You can view them as your private Bitcoin banking partner tailored to your wealth preservation goals. Whether you're new to Bitcoin or an experienced holder, OnRamp's approach helps you secure your generational wealth with unmatched security and peace of mind. You can sign up at onrampbitcoin.com and use code BRAM, that's BRAM, to receive $150 in Bitcoin after your first deposit. If you first want to learn more, you can also book a free consultation via their website to speak with one of their Bitcoin custody experts. Tell them you came through me, and they'll take extra good care of you. My American friends, I've got something for you. If you're into Bitcoin, you want to grow your stack in any way possible. What if you could do it effortlessly just by spending your fiat? The Gemini Bitcoin credit card is designed to help you do just that, by giving you instant Bitcoin rewards on every purchase. Just use it like any other credit card and earn back up to 4% on transportation, 3% on dining, 2% on groceries, and 1% on everything else. There are no annual fees for this card and no exchange fees to receive your Bitcoin rewards. Sign up to get your limited edition Bitcoin Orange credit card and earn a $200 Bitcoin bonus when you spend $3,000 in the first 90 days. You can find more information and terms in the description below, or go to gemini.com/Bram to sign up today and start stacking effortlessly. That's gemini.com/Bram.
Yep. So, it's hard for people I know who are impatient and don't have a long time preference, but a lot of people are acting like this drawdown is the end of the world. And it's, we've seen much worse, right? It went from 65 to 15. I mean,
it's just surprising to happen at this point of the year.
I think that's right.
What's going on?
I think that's right.
But we need to talk about gold, because look, people are very frustrated that Bitcoin is not digital gold yet. And it's just not. Does it have the characteristics of it? Yeah, it has not been adopted as digital gold yet, though. You can see, or else it would have run with gold. The problem is that it's still widely misunderstood, even on Wall Street. It's lumped in with a bunch of other garbage that people don't understand how it's different and how it's fully decentralized and all of that. And we're not going to bore your knowledgeable listeners with that, Bram. But gold has run because of a great amount of uncertainty in markets, but primarily because of what Larry touched on before, which is the central bankers around the world understand that the Fed is trapped. Yeah. They're going to print. They're going to debase our currency. And, we've talked about this before, but we got to hit on this again. This cannot be overstated just how monumentally stupid it was for the Biden administration to seize treasuries from Russia and kick them off the SWIFT network when they invaded Ukraine. We can't overestimate how dumb that was and catastrophic it was for the U.S. Treasury. Yeah. And if you're wondering what that meant, Look at gold and look at gold's price and look at who's been buying it. It's been central bankers from across the world have been buying gold and buying a lot fewer U.S. Treasuries, by the way. Why? Because they know damn well that two things are important here. Number one, if the U.S. government doesn't like what you do and you're not a close ally of them, then they may just kick you off the SWIFT network and take your treasuries. You know, that's number one. Number two, and even, you know, earlier this year, Putin even said it. He said, the U.S. government is going to keep printing money and they're going to keep debasing the dollar. Why would I want to own something that's going to be worth less in the future? Well, that's a good question. So they all know that they're trapped, and they understand that they don't want to be holding treasuries in you know, an antagonistic environment or an uncertain geopolitical environment, especially the BRICS nations and the add-ons. So the BRICS Plus, there's a lot of nations out there who are moving away from treasuries. And Luke Groman talks about this quite a bit, and they're moving towards gold. Well, I think eventually they're going to move towards Bitcoin too, but that just hasn't solidified yet. We're getting there. We will get there, and I think that Larry hit on it.
But we've seen this pattern before, and this is exactly what happened in 2008. I mean, you know, and 18 and 19. I mean, you know, there was the repo blowout in 19, then COVID in 2020, and gold was taken off like a rocket ship, and Bitcoin sat there flat as a rock, slightly down. And then one day it woke up and it went from 10,000 to 60,000 in 5 months.
Yeah.
And it was kind of like, oh, I get it. And that's what's going to happen. That's what's going to happen here. I don't know if it's going to do a six-bagger, but it's going to go up a lot. I would also like to add, not supporting the gold side and just the overall macro picture that's positive, is that our trade now has a name. It's the monetary debasement trade. JP Morgan coined it that. You know, and now Mohammed El-Arian and all these other elites are out there talking as if they invented the idea. Of course, there's some of us who've been saying this for decades, and you know, it's unusual. I mean, things that happened recently that I would never thought I would see happen. How's this for one? Morgan Stanley, one of the biggest wirehouses in the country, high end, you know, with trillions of dollars in assets under management, changed their model from 60% stocks, 40% bonds, to 60% stock, 20% bonds, 20% gold. And I was like, what? Wow. What are you talking about? And one of the gold guys did the math and said, well, if all of their clients actually followed that recommendation, gold would be at $12,000 tomorrow, because just given how big the Morgan Stanley asset base is. I don't know if he did the calculation right, but the point is, I mean, this is a very large change in sentiment. And so,
Druckenmiller says it. Galio says it. You know, they're all. They're all really winning. An allocation to gold. What's gold and Bitcoin, by the way.
Yeah, what's not happening though is, you know, Bitcoin is the most sensitive to the liquidity piece, and liquidity is being drained. And so the other thing we need to have happen, I know James agrees with me on this, is we just need to have all these other crypto shitcoins die, because there's a certain amount of, you know, we're getting yanked around by them, because there's some Bitcoin holders who are only holding Bitcoin as an interim between their punts into Solana, and, you know, now the new one, the hot new one now is Zcash, and all these are just pump and dump bullshit. But, you know, when those things go down, you know, some of those guys have to sell, and they have to sell their Bitcoin. So, you know, it's all tied together in the liquidity swamp. But, you know, throughout it all, Bitcoin just keeps ticking away, a block every 10 minutes. And, you know, I have no doubt that we'll be at much higher prices. I have to say, I am surprised. I thought pretty likely we'd be at 140 by the end of this year. And I'm with James. I think the 4-year cycle is over. I think the 4-year cycle was kind of driven by the halving when the rewards were bigger. Now the rewards are so small compared to the IBIT buying and all the other stuff. I just don't think the 4-year cycle matters. I think there will be cycles just driven, like there are cycles in every market, just driven by fear and greed. And people will get levered up and get way too far out over their skis. And then, you know, of course, things will correct. And so my model is still that we go to 250, and then we have a 50% correction. But one thing that also truncated the cycle in this particular thing was this whole notion, and I'm angry at a few of the larger influencers for pushing it, that these Bitcoin treasury companies were just free money machines. And that, you know, you could basically sell at a premium, you know, increase your Bitcoin per share and wash, rinse, and repeat forever. never accounting for the fact that the premium could disappear. And, that hurt a lot of people. And so, and there was a lot of money that probably there were some OG Bitcoiners. I know of a couple actually who sold some of their Bitcoin and to dump it into Treasury companies. And, it turns out if you bought those at big MNAVs, you're now coming to learn why banks only trade at 1.5 to 2 times book value.
That's the key right there. So let's talk about that for a second, because in the big, Larry is he's an advisory partner in the Bitcoin Opportunity Fund that David Foley and I run, and we are invested in a number of these companies, and a handful of them. I'm on the board of Strive, and so there is a case for these.
Absolutely.
And I believe that there's a long-term runway for these, that they'll do extremely well as Bitcoin does well. But caveat, book value is really important. And our book value on these is MNAV. It's the Bitcoin MNAV. How much Bitcoin do they own? And if you fully dilute all of the shares, and this is where people get this all tangled up, and they rely on just looking at these Bitcoin Treasury websites that list the treasuries and their MNAVs. You got to do the work yourself. You got to get in there. If you're going to buy one of these stocks, you've got to get in there, read the 10Ks, read the 10Qs, understand how many shares they have, how much debt they have, how much of that debt can be converted into shares, and what are the actual claims on that from the total enterprise value. And you've got to look at the total enterprise value to get to what the real MNAV is. And so if you don't understand that, please go and research it. Use Grok or use ChatGPT, something to go and research these things. Because if you're buying, some of these companies were trading at absolutely insane MNAVs. Okay, so let's talk through this really quickly. There are a few companies that we bought that we put in for the private placement. These are pipes, okay? Private placements that we bought back in the spring, May, June. And we didn't get shares until August, September, October, okay? So we sat on these things and watched them trade all the way up in the public market. We didn't have our shares. We just watched them trade all the way up to ridiculous MNAVs, 5, 6, 10, 12, 18 MNAV. And it's like, we didn't understand. We're looking at them going, if we had our shares, we would be selling here, because it just makes no sense. And of course, they all came back down to earth. And it goes back to the statement that Larry just made, which is there's a reason that we look at these things and attach somewhere around a 1.5 or 2 book value on them, on banks or other companies, right? So why would we do that? Because long term, that's the velocity of capital you're looking at in order to generate these great long term returns for your shareholders. Can you do that with Bitcoin? You can. And I think that Michael Saylor unlocked a really, beautiful model in the preferred equity, where, especially with the stretch preferred, where you can move around the yield in order to make sure that you keep that security at somewhat of a constant price in the market. And that gets you closer to a money market vehicle, which has a much, much, much higher yield than your regular money market that you're going to get over at Fidelity or Schwab. And so really important, though, is that that's a key component. And that's why we did that same exact thing over at Strive. And so, but it's not open to everybody. Like, not every company can do this. You have to have a strong balance sheet. You have to have strong management, and you have to have strong connections and understanding and a path to the capital markets. Not everybody can just come out with a Bitcoin treasury company and call the capital markets and say, hey, we want to float this pref. They have to have serious relationships with very large institutions to float that pref. And that's really important to understand. So what this gets us down to the point of, not all of these companies are going to survive.
Right.
Some of them will trade under 1 MNAV until they're acquired or they're liquidated.
Right.
There's likely they'll be acquired, or they just will start buying back shares, because you're buying basically Bitcoin at a discount at that point. But not every single one of them is going to survive. There are a handful that we believe in, and I know Larry does too. We are very symbiotic on our beliefs on which ones are the strong ones, and we hold those long term in our fund because we do believe in them. But we have a very tight discipline around where we will own them and where we will sell them on the MNAVs. Yeah. And because that's how our brains work long term, and it's how the capital markets are going to work too. People just need to understand that.
Yeah. I mean, this is why I wanted to invite you. I mean, I asked one question, and this is just straight rip. So thank you.
For an hour, yeah.
Maybe to give a little summary of this first part, because it's actually something I wanted to ask a question about, but you already answered. But I saw Larry, first I saw Jack Mallers calling Bitcoin a liquidity smoke alarm. I think that's what you guys just touched upon.
That's what I was saying too. Yeah.
Yeah, and Larry reposted a tweet that said, "Gold hitting new highs is the market admitting inflation never left. Bitcoin pulling back at the same time is a signal that liquidity stress is real and the cracks are widening underneath the surface." That's the difference between the two. Gold reacts to what the system already printed. Bitcoin reacts to what the system cannot print anymore. Once the liquidity boom comes, gold will rise, but Bitcoin will reprice the entire monetary order.
I thought that was a great tweet. I don't know who I borrowed that from, but whoever wrote that put it in very good, elegant terms.
Yeah, that was really great. So, and this is kind of like what surprises me, right? So both of you have really helped me along the way to understand kind of like the bigger macro picture. Why does Bitcoin exist? You know, what is happening? And I kind of think and feel that a lot of people are very impatient or bored, I don't know, and they're kind of forgetting what Bitcoin is here to do, right? And this is also the reason why I invited you. Like, I think we have to wake up everyone again and make them understand this bigger battle that we're in. And I think you kind of went through it already. So my question now is, why do you think, or how do you argue that Bitcoin is uniquely primed to become this safe haven asset in a risk-off environment? And I think, to touch upon what you said, James, these are some of the conversations I've had too from people that are into Bitcoin, think Bitcoin is a superior monetary asset over gold, but they tell me, hold your horses, because all the central banks are buying gold and not Bitcoin yet, right? So the majority of the people that should know basically have no clue. So you need to be patient. So we know the thesis, but why Bitcoin?
Well, we know it's digital capital. It's easier to move, easier to store, more verifiable, and harder than gold on a stock to flow basis. And as Saifedean has said for years and years, and is documented historically, the hardest money always wins. I mean, look, the Chinese are betting on gold, okay? But the Chinese bet on silver in the 1800s, and it crushed them. The Indians did as well. And, this is a superior form of money because it's auditable, visible, transferable, and probably most importantly, scarce. And the reason why it's so hard to get your head around is there's never been anything like this before. I mean, for all of human existence, really, whatever form of money was used was dilutable. And here you've got something that's mathematically not dilutable. So people are having a very hard time getting their head around that. And that's why it trades like the wild animal that it trades like. But, it's already started to displace gold. I mean, we can debate how quickly it'll happen. Gold's not going away tomorrow. I fully expect gold to go to 10,000, but I also fully expect Bitcoin to go to 1 million. So, they're both good numbers. I actually, the way, I'll just say this quickly and then I'll let James add on. I actually kind of view gold as like owning a bond, and Bitcoin is like owning a growth equity. I mean, it's just in terms of the investment characteristics. I mean, and growth equities are volatile, but they give you more alpha. And bonds are less volatile, but they're, they just kind of tick away and, they hold their value. I mean, M2 grows at 77% a year since forever, really, since 71. And, guess what? Gold's value has grown at about the same rate. It just hangs in there. So
so that's a really good point. So why would you say that it's a growth equity? Well, I think that the point that Larry's making is that because we have not had full adoption of Bitcoin yet, we've had full adoption of gold. Right. Everybody knows what gold is. Everybody knows what gold's use is. They understand that it's what you own when there's massive uncertainty in the world. We got to touch on a few things here. First of all, we've said this before, ad nauseum. if there's a market shock, gold will sell off too.
Oh, yeah.
Everything will sell off. Everything correlates to one. And the reason for that is that when you're a hedge fund manager and you walk into the office, to your desk in the morning, and there's some sort of market shock, you don't look at your traders and say, hey, can you kind of figure out what we can get out of like 10% or 20% of without really taking too much of a hit? You don't say that. You walk in and you say, sell 10% of everything, sell 20%. Just get me out of everything. So across the board, everybody at your stations, go. And they just go and just sell. They just sell. Everything correlates to one, and that's why you have market shocks. Right. And that's in that situation, Bitcoin's going to get hit really hard. Okay, that's just reality. And gold will get hit hard too. Everything will. Right. But let's go back to Larry's point, which is, Bitcoin is more like a growth equity because it has not been fully adopted yet. It is still very early in the adoption phase.
If you want to self-custody your Bitcoin stack, I recommend the Blockstream Jade Plus. I've been using this premium Bitcoin-only hardware wallet for a few months now, and I love its design and ease of use. What makes it stand out is its open source hardware and software, and Blockstream's unique genuine check, which makes sure that your device is authentic. No backdoors or compromises. You can connect with the Jade Plus however you want. Bluetooth, USB-C, or you can go fully air-gapped with its built-in camera for cable-free QR transactions. The metal case feels solid and the color screen is easy to read, and it connects with your favorite Bitcoin apps like Blockstream Green, Sparrow, and Electrum. Get your Jade Plus today at store.blockstream.com and use code BRAM to get 10% of your entire order. Let's talk about something a lot of people don't think about before it's too late. Where are you storing your Bitcoin seed words? Are they truly secure? I found my solution with Stampseed. They now offer both 12 and 24 word titanium plates, so whether you're securing a hardware wallet or a multi-sig setup, they got you covered. Your seed phrase gets permanently stamped into pure titanium that withstands fire, survives water, and lasts for generations. Unlike shallow etching methods, Stampseed's patented tools help you to deeply stamp every letter for permanent readability, protecting your financial legacy. Their new kit includes test pieces for practice and is compatible with both the 12 and the 24 word plates. Paper seed phrases are a disaster waiting to happen. Secure your Bitcoin with Stampseed for decades to come. Go to stampseed.com and use code BRAM, that's BRAM, for 15% of your order.
If we go and look at, that chart that Jesse Myers puts out, Croesus, that shows the total investable assets in the universe, and it's about 1 quadrillion of assets, a little bit less today, but it's about 1 quadrillion of assets in the world. Well, Bitcoin's a tiny fraction of that, and Bitcoin is at $2 trillion, is just a tiny fraction of that.
0.2%.
0.2%. But Bitcoin has only been around for 15 years, and it's already about the 10th the size of gold, which is just mind-blowing, okay? Now, it's got a lot of buckets it'll draw from. It's been drawing from the equity bucket up until now. It's really been drawing from the, risk-on bucket. It has not drawn from gold, or it has not drawn from bonds. It's not really drawn much from real estate, maybe a little bit, but not much. Bitcoin is poised as broad adoption occurs. And what I mean by that is when you get the institutions like Harvard and some other very large investors, large institutions, I'm talking about pension funds, endowments, that understand Bitcoin, how it's different from all the other coins, like Larry just said, all the shit coins, and they do understand how it's different from Ethereum and Solana and all the rest of them. Well, it'll be adopted in a different way, and they'll start taking money from different buckets to allocate to it. Why would they do that? They'll do that because of the premise of the start of this show, which was the Fed is trapped, the Treasury is trapped. They have no choice. They have to keep printing. They have to keep debasing the dollar. So in the world of debasement, what do you want to own? Do you want to own bonds? I don't. That's a negative real return. You're going to put your money in a dollar-denominated security that's going to give you a lower yield than the real inflation rate. That's not a good place to park your money. It's not a good place to park your money in real estate sometimes, because real estate as an investment, it's illiquid. You know, you got to pay taxes on it, you have maintenance, you have upkeep, you have to deal with, if you're using it for cash flow, you have to deal with renters and all that, and being a landlord. Is it a good place to be if you want to run a business? Long term, it could be a good place. I'm not saying that, but just purely as just an investment to hide in with your capital, it's a better place to put your money in Bitcoin, and people will start to understand that, and it'll draw from that bucket. But once it starts drawing from bonds, from real estate, you're going to see a different rate of adoption, which means that's why you have this growth equity component to it, which means that as it's taking market share from gold, as it's taking market share from real estate, as it's taking market share from bonds, it will grow in price at a faster rate, because that 20 basis points of 1%, 0.2 of 1% of total global investable assets will become 1, 2, 3%. And then Bitcoin isn't that just $1 million? It's far above that.
Yeah,
and so that's the point.
Look at the same numbers for gold. I mean, gold is 27 trillion out of that 100,000 trillion, or what is it, a quadrillion? So gold is 2.7% of total global assets. And, here you are, you've got these central banks that are just completely out of control. You've got this monetary system that mathematically has to create more debt and money, or else it's going to implode. I mean, it just doesn't take that much, Bram, for, the bonds, the equities, the cash, the real estate, for all these people to say, gee whiz, I got to get out of these things that are getting, real estate not as bad, but particularly bonds and equities, I got to get out of these things that they can print and into stuff that just can't be printed. And so that gold number is going to go up a lot too. I mean, that 2.7%, if you go back to like in the 1980 time frame, it was 5 or 6 times that amount. I mean, depending on how you measured it, gold was, 15 to 20% of global financial assets at its peak in 80. At that point in time, it actually covered the U.S. money supply. And by the way, we could be headed there again. And I guess that's the point I would make. One of the things I want to say about what I said earlier, I said this is a monetary debasement trade. That's really wrong. It's not a trade. Okay.
Not a trade.
A trade implies that, oh yeah, I'm in this for a while. And you're seeing that now. You're seeing you're seeing some of these Wall Street types. Oh, look, I bought Bitcoin at 60, it's at 100. I feel good. I made 100%. I'm out. No, wrong choice. Where are you going to go? It's a monetary debasement trend. And what I think people are going to be shocked by is how, 2 years, 4 years, 6 years, 8 years from now, gold's going to follow, the path upward towards, 6, 8, 10, 12. I mean, I could easily see $20,000 gold. And, Bitcoin's going to go 150, 200, 250, 300, 400. I mean, that power law projects that Bitcoin will be at $1 million in 2032. And I think that's probably right. It might be conservative, if we really have a big financial accident and they print a ton of money. So, to me, these are just, all you need to know is that both of these things are going up and to the right for many, many years. And we're probably in the second inning of at least a 9-inning game that might go into overtime. So, or extra innings. So, another stat that I'll cite, because I cited it in this presentation I just gave, it just blows my mind. It tells you what James is talking about, when we grabbed that sovereign debt from, when we grabbed those bonds from Russia. So since 2020, when COVID hit, in bond terms, Bitcoin is up 2,000%, 20x. And in gold terms, gold is up 277%, so almost 3x. So that's 20 years. That's the past 5 years. So that, to me, those two charts are prima facie evidence that we are in a sovereign debt crisis. And it's being expressed by these two alternative forms of money and how they're just kicking the ass on, of government bonds, because nobody wants those bonds.
Yeah. This is exactly why I wanted to talk to you guys, because this is the thesis, right? Like, right. I think this is what people are dismissing. There are multiple options to escape this mathematically assured fiat money debasement. There is one road. It's a path-dependent thing. But as James just explained, you have to look at the characteristics of what you can escape to, right? And gold, in that sense, has been money for 5,000 years. You could use it locally, right? You could go to the farmer's market or maybe the supermarket when the
Yeah, it's pretty hard to use for transactions. But
exactly. Well, that's my point, right? The characteristics of Bitcoin are superior, right? It's a digital commodity, it's digital capital, however you want to define it, controlled by no one, and we can use it all over the world with instant final settlement, etc. So this is the big picture of how people need to think through it. Like you said, it's not a trade. I said it's the last trade, right? You trade once.
that's right.
But here's the, Go ahead, Bram. I didn't mean to interrupt you.
No, I mean, like this, there aren't many more words. Like, this is the thesis. So you need to understand the characteristics of Bitcoin in order to understand that from all the lifeboats that you could potentially choose, this is the best one, and then compared to any of the other ones.
Yeah, it's the best one if you can handle the volatility. And I mean, well, and that's important. That's an important point to make because, you know, I mean, I put some people into Bitcoin at 65. It went to 15. They got mad at me and they sold it. Do you know what I mean? And so I've altered my pitch when I'm, you know, and I have my clients. I run a gold and silver stock mining fund, so my clients tend to be older, more conservative. And they ask, but a lot of them understand the Bitcoin thesis, and they ask me, how should I get in? How much should I buy? And I said, well, I think the way you look at it is this. You know, we've had multiple drawdowns that have been big, you know, some as large as 70%. I don't think we're going to have any more of those, but we could easily see 50 or 60. I think what you put into Bitcoin is a number where if the got drawn down 50%, you would say to yourself, oh, that's a drag, but I'm going to buy more. Instead of saying to yourself, "Oh shit, I made a mistake. I'm going to sell it," because
this is,
you know, if you can hold it for 4 years, you know you're going to be money good on it again, right? But you have to, you know, and so you're 80 years old. You're not going to take your net worth and put it into Bitcoin. You don't want that roller coaster ride. But you might want to put 5% of your net worth into Bitcoin because if it goes down 50% and you lose 2.5%. I mean, one, you're not going to lose if you keep waiting, and two, that's something you can absorb and it's not going to freak you out, right?
Right. And that was about right before you said that. What I was going to say is, look, that's the thesis, right? The overarching thesis is what we've defined on the expansion of global liquidity. The world, the financial world operates on debt and liquidity. That's just what it is. And so that's number one. Number two, volatility is scary.
Yeah.
It's really scary. And so the people are sitting here going that have bought at 100, 105, 110, and now it's trading at $90,000. They're like, what have I done? I mean, this is just insane. Oh my God, this thing moves around, it whips around. It's unnerving. And I'll admit, you know, like I come from an arbitrage background before I did the microcap and private equity kind of world. Before that I was in arbitrage, which was, if something moved 1 or 2%, it was catastrophic. It was like, wow, this is a massive move. You know, this thing has moved 1 or 2% 5 times in this conversation. You know, so and you just have to kind of and Saylor says embrace the volatility, and look, in a way that's right. Volatility it's necessary for an asset that's being adopted. It's just reality, and it means that there's larger and larger swaths of capital that are moving in and out of it, and it's looking for those liquidity prices. You know, prices of liquidity.
The market is still trying to figure out what it is, and so one day it's going to the moon, and you never get enough of it, and the next day Bitcoin is dead. And, you know, I remember this very clearly looking at Amazon as a comparable because, you know, we all know what Amazon is today. It's the leading seller of goods and services online. But it wasn't always that way. It started off just selling books and expanded into other things. And it had a drawdown of 90% after 2008. It had multiple drawdowns of 70, 50, whatever. And yet, you know, if you're Bill Miller and you're smart enough to buy those dips or at least hang on during those dips, you know, the stock has gone up 212,000% from the time when it went public, right? And it's also a network business, which, you know, as you know, Bitcoin's built on the network. It's a protocol that is the network protocol, and protocols are winner-take-all phenomena. And so, you know, we kind of, I mean, to me, it's just, I'm very comfortable knowing what's going to happen here. And honestly, I mean, with a lot of people, I mean, I think they're watching the price too much. I mean, there are days when I don't even look at the price. I'm just kind of like, whatever, you know. And I mean, and my wife's like, "What did it do today?" I'm like, "I don't know." You know, oh, it's down. I'm like, yeah, so, you know, right? I mean, it's
So?
yeah. So, I mean, I'm pretty sure
Like you said, it's volatile, and every single day that ends with a Y.
Yeah, days why, right? Yeah.
At least it's being used, right? Like it's being acknowledged.
Right. Well, I mean, what's going on is there's a very healthy debate about what it's worth, right? That's what's going on.
Yeah.
I mean, those of us who own it and believe in it, we know it's worth a lot more than the price right now in 5 years. And those people who are selling it, they don't believe that. They're taking the other side of that. Fine.
Yeah.
By the way, some of those sellers are paper sellers. I mean, you know, in spite of all these positive developments, there's probably a pretty good sized derivatives market. I haven't looked at it recently. I've been meaning to do that. But, you know, there's a futures contract on Bitcoin, and you can come in and sell Bitcoin you don't have in a contract to somebody who wants to buy the other side of that contract. And, you know, if you're stupid enough to do that, you know, too bad, because you're going to get your face ripped off, because, you know, when it moves extremely quickly and you have a hard time covering it. But, you know, there are a lot of games going on. And the reason I can relate to that is because I've seen that in the gold market for a number of years. I mean, there's been a lot of paper gold created, and, you know, they're starting to create a little bit of paper Bitcoin. And sadly, this is part of the process of, you know, when you get all the Wall Street firms involved, you get everybody buying it, you get it to be widely accepted. This is what happens. But I mean, I got to tell you, it's getting to be really widely accepted. I had some skeptical friends. I have a skeptical friend who's close to being a billionaire, and I was trying to get him to buy it at 5, 10, 20, not a bite. And he just came to me and said, you know, how do I do this? I want to take a 5% position. And I was like, oh, okay.
Well, I think that's super interesting, right? Because like you mentioned before, people are figuring out, you know, what is this? And now that the price is going down, I see all the TradFi, you know, how do you say that, mid-range, right? Like the mid-curve people coming out and being like, I told you so. They never.
They're all jumping
right?
on. Some guy got on my Twitter feed and said, you know, how are you going to be able to live with yourself when you wrecked all those people that you recommended go into Bitcoin? You know, you should have been like Peter Schiff or something. And I felt like saying, how does Peter Schiff live with himself knowing that for 16 years he's advised people to avoid something that would have made them fabulously rich? Do you know what I mean?
Yeah.
And you know, and I mean, this guy is saying this on a correction from, you know, 125 to 95, right? Mm-hmm. I mean, come on. This is a dip for ants. I mean,
yeah. Well, what I wanted to ask is, so people are figuring it out. These guys are coming out of the woodworks, right? It's so funny because I think, like, I never tweet about Microsoft or Netflix or whatever, right? Like, stay in your lane. Like, I don't really care. But I do think retail or just general plebs, are very far from Bitcoin, especially after all the FTX, other crypto debacle, etc. But like you said, James, in the beginning, a lot of whales have been selling, but the market has been absorbing, right? Like just over 100K, now also in this 93, 95 range. Who's buying if it's not retail?
Well, I mean, there are a lot of smaller institutions, smaller. There is some retail buying. You know, it's hard to tell because you've got BlackRock, IBIT, and FBTC, and those are just they're wrappers of Bitcoin for people who have IRAs and who have their personal trading accounts. So, you know, but you can see if you pull up IBIT, you can see some of the largest. Some of the largest buyers as of the end of 9/30 were, you know, Jane Street, Goldman Sachs, Morgan Stanley, BlackRock. You know, I mean, the Abu Dhabi.
Harvard Endowment is on there, aren't they, James? I think
Harvard Endowment is on here. They're holder number 17. They bought 5 million shares of IBIT over the last quarter. You know,
actually, I'll tell you who's buying it. Actually, you know what it is? It's the readers of my book. They bought my book and they listen to me. And they're rich and they're in there chasing it.
Yeah. Well, I think it's widening out though. So the answer is, if you have all these OGs selling, and it's really consolidated in a number of small like a small number of hands, and then it's being widely distributed to many more hands. That is going to dampen the volatility. I think that we had blow off tops and crashes before because it was just concentrated. There wasn't as much volume. You pull up Bitcoin today and you're looking at volumes on a daily now. You've got candles that are like 13, 35, well, 30, 29, and 35,000 coins in a day, billions and billions of dollars.
Yeah, and the way the whole thing calms down is these big accounts, they don't go in and jam the price and just start to buy as much as they can, as fast as they can. They're smart. They sit there and they just layer in, they have a whole stack of orders. I mean, I'm sure, if you're a big institutional investor and you want to express an interest in Bitcoin, you just sit there and you do a ladder all the way down to 60, and you basically say, okay, if it drops to this, I'll buy this amount, and maybe you weight it heavier at the bottom so that because that your time frame is very long, that you're not trading it, right?
And they VWAP it,
Yeah, exactly.
They volume weighted average price where you just give your trader, you're like, all right, we want to put 1% of our portfolio into this. Well, if the portfolio is $100 million, it's $1 million that you're going to go out and buy over the course of the day or the course of the week, and they're just like, well, just figure out the volume and just be a portion of volume and spread it out over the next few days. And then the trader does that. And so they just go along. And what'll happen is you get 5 or 10 really big institutions that happen to be going along at the same time together. The price is going to go up. It's going to enter price discovery, which we expected to happen once we got to new highs. But lo and behold, OGs had another idea, which was just get out, sell all my coins, get me out. And so they did, and they pummeled the price.
Yeah. I think showing the book was a nice bridge, Larry, because I wanted to ask. I'm also looking at the time, so I'm
always selling.
I'm going to connect some questions together. But I wanted to ask. You mentioned, that kind of like timeline for the big print or when it's happening, kind of like a year. This is what I wanted to ask. Like, what timeline should people be?
I'll be interested in James's view. I mean, just looking at patterns, charts, tightness, etc. I can't imagine we make it a year without a big print. And of course, you get into the.
Well, you tweeted it was imminent, so that's why I'm asking.
And it feels kind of imminent, but I want to give myself some breathing room. I mean, let me say this: printing is imminent. I mean, they're almost doing that now. I mean, the Treasury is buying 10-year bonds with TGA money that they raise by selling short bonds. So that's kind of an Operation Twist, QE, backdoor QE. So they're already, quote unquote, kind of printing because a short-term bond is almost, it's almost like cash. But, the big print, I mean, the size, order of magnitude, growth, et cetera, it tends to historically, that's been triggered by some kind of an event. Something getting discontinuous, the basis trade blowing up, like it did when they bailed out Ken Griffin. And what's going to trigger that? I don't know. We don't know. There's leverage all over the place. You've got, Tricolor goes bankrupt. You've got, First Brands goes bankrupt. You discover there was fraud in both of those. You've got this whole private credit market that is very opaque. You've got all these private equity deals that are marked to myth or market. I mean, if you marked them to real market, they might take big. I mean, at some point in time, I mean, history shows that when you layer debt on debt on debt, you get an enormous credit structure over too far out, quote unquote, over its skis. Something breaks, and it's like the tide goes out, and everyone says, "Who's naked?" And and it's just a daisy chain. And and the swap. I mean, by the way, it just recently happened to Argentina. Okay, and what do? Swap line. Oh, how much? 20 bill. Oh no, not 20 bill. A week later, it's 40 bill. Because they're trying to defend the Argentine peso because we don't want Argentina to fall under the influence of China. I mean, it just we don't know exactly what's going to break. We don't know exactly what is going to happen. I'd be curious how James sees it.
Yeah, maybe James, to weave into that, will it be suddenly? Like, how do people know when this starts? What should people
you won't
look
miss it.
for?
Well, so let's start with back in 2008. There was a lot of talk about the housing crisis, and the obvious thing was that this couldn't be sustained. It was unsustainable. The less obvious thing about it was, well, houses always go up. Like they never go down in price. And so, historically that was true, but then it was different. So this time really was different then. Well, I would characterize today as a little bit different in that, and Larry's written all about this in his book, everything, what happened in 2008 was there was a massive debt crisis. There was a that could not be absorbed without destroying the economy, which we basically did. But then we printed $1 trillion and kicked that risk from the banks to the sovereigns. And some of the sovereigns are holding that debt. Basically, there are, all the Fed has, they kicked up $1 trillion there, and then they kicked up another $5 trillion during, the Great Financial Crisis. Then they kicked up another $5 trillion during COVID. So here's how I would say it. I would agree wholeheartedly with Larry that, look, we're skating on an edge now. Okay, so the reason that it's scary is because there's so much leverage in the system, and we will continue with liquidity. Like Powell said, the banks are getting to the point where we're going to have to add liquidity to the reserves. That's going to be QE, not QE, like we discussed earlier in the show. The bigger problem is that just the sheer amount of debt, borrowing, and leverage there is in the system. And so the way I would kind of characterize it is that, when you were a kid, you played that game in field day where you were throw the egg back and forth to each other, and everybody starts out, they're right next to each other. And then they're a foot apart. Then they're 2 feet apart. Then they're 3 feet apart. And then they're 5 feet apart. So we're tossing this egg back and forth, and we're like 50 feet apart now. You could keep doing this for a long time if you have skilled players and, you've got some help in the system. You could just keep throwing that egg back and forth, back and forth, back and forth. But eventually it's gonna crack. Something's gonna break eventually. You just have so much leverage. Everybody has leverage on their balance sheet and we're talking about not just the sovereigns. We're talking about corporations, talking about banks, talking about companies. You're talking about individuals. Everybody's got leverage except probably the 1% if their leverage is covered. But everybody's got leverage, and the system is teetering on that leverage. And at some point, something does break. It will happen. But like I said, you can be throwing this egg back and forth for a long time. But eventually, it's going to break. There's just a probability. And the probability is that there's just too much leverage, and and that leverage is the distance between people. And so eventually something's going to break. It's just a question of when. It could be tomorrow. It could be 2027.
Yeah.
I think it's going to be somewhere in between.
Yeah. So you don't think we make it to 20?
I think it's somewhere between, who knows? I mean, like we've said, let's put it this way. We just saw really tight liquidity conditions at the end of October. Why is that? Well, bank reserves have fallen. They've gotten down to a point where they're below that 10% threshold that that's right about 8 to 10% is where the Fed says, yeah, they're ample-ish, because they need the velocity of capital, okay? And 10% of GDP is what I'm talking about. And then there's also the 10 to 12% of total bank assets. That's another measure. But we're getting to that point where in 2019, they got down to 7% of GDP, the bank reserves, and the repo market blew up. It imploded. The whole system locked up, and the Fed had to stop QT and turn around with QE literally in 2 days. And so that could happen. What we saw at the end of October, well, what echoes 2019? Well, 2019, we had, and I wrote all about this. If anybody wants to read more about it, it's in my informationist. But really quickly, in 2019, we had a confluence of events where you had tax payments were due for corporations. You had the Treasury came out with a larger QRA than was expected, larger refunding announcement, and then dollars were needed overseas, and so you had a shortage of dollars basically, and so the repo markets blew up where you were using your Treasuries to borrow dollars from other financial institutions. Then there just weren't enough to go around, so that rate spiked from just a few percent to like 9%. Intraday. It would be like your floating rate mortgage tripling overnight, Then so it became a massive problem. Well, what we saw just now in October was not the same, but it was short term, just like it was last in 2019. But it doesn't matter if it's short term or not. There are some differences though. The first difference is now we have a standing repo facility. The Fed learned its lesson that they've got to be the fireman standing at the ready at any moment to make sure that they offer liquidity to institutions that need it, to financial institutions that need it. So they're sitting there, but it's not open to everybody. And so what you're seeing is what you noticed at the end of October was, you've got banks like JP Morgan and Morgan Stanley, whatever, Goldman Sachs are saying, oh, liquidity is fine. Yeah, it's fine for you. You've got enough capital, but you're not willing to lend it. Right. And if you are willing to lend it, you're going to charge a little bit of an arm and a leg to the financial company that needs it. And what I mean by that is you saw that the repo rate spike at the end of October and the need for liquidity spike at the end of October. There was a $50 billion draw on the repo market.
Yeah.
Yeah, the standing repo facility, and the rate spiked up to 36 basis points over Fed funds. That's a massive move overnight. It settled back down because it was end of month window dressing, likely because of companies needing to get their leverage ratios in order and all that. But that was just an indication that there's not enough.
The signs are there.
It's just not normal. It happens at the end of the month a little bit, but that was out of bounds. What's that, Larry?
I was just going to say the signs are there. We're just
signs are there. So
yeah.
It could happen any day. We just don't know. You could have any one of these companies blow up. You've seen companies blow up. Some of the auto-related companies blow up recently. You could see any company blow up, and the question is, how much does that blow up? How much does that affect other players involved, and how much contagion is there? How big is it, and how much contagion is there? But it could happen at any moment where a company needs more money, more dollars than are out there to borrow, or that a company is willing to lend them at a rate that will get them over the hump. And that's the big question. And so could it happen tomorrow? Sure. Could happen by the end of this call, but I don't think it will, but it could. There's enough leverage in the system that it could happen at any moment. So that's just to keep people on guard and to understand what's going on in the system. And in that situation, and we do have a blow up like that, you're going to have a big print. It's not going to be $2 trillion. It's going to be a whole lot more, multiples of that.
Yeah.
So if we get to that point, this is a question I got from X for both of you. Are you positioning yourselves for like a structured, deliberate global reset? Everyone is working together, or either like a Weimar type hyperinflation event, or maybe something entirely else? Like what does that look like? Like you said, we get to that point, the glue totally dissolved, the distance is too big.
I think that would be catastrophic. Yeah, I think it'd be catastrophic for us to just jump off the dollar system. That would be pretty bad. My base case is that we have at least one more big print in us before it begins to really unravel. it's unraveling now. You can see that people are, there's no reason for central banks to be buying gold in this day and age unless they're worried about the counterparty risk.
Yeah.
And they're clearly worried. And that's a reason that, the United States government doesn't hold the AAA status anymore for their bonds. There's a reason for that. So, but Larry, what do you think?
I think this big print will lead to very high inflation, and I think that there'll be a lot of pain in the next 2 or 3 years.
High, but not hyper. Yeah.
Not hyper, just high,
Yeah.
like over 9, like double digit, like 12, 15. And I think that that will lead to the blue team winning in 2028. And then I think that team will finish off fiat currency. They'll, go to UBI, debt forgiveness. Stephanie Kelton will be Treasury Secretary. They'll say deficits don't matter, and the currency will fail. And then I think that in 2032, Michael Saylor will be elected president because he'll be the richest man in the world, and he'll say, I'm an MIT grad, I'm an engineer, I'm a historian, I know how we got here, I know what's wrong, I actually know how we could save America. And he will put us on a Bitcoin standard, and off we go. And the fourth turning will be over.
It's important to put in context, though, because you have a lot of young listeners, I'm sure.
Yeah.
I don't, my whole life we've been on the dollar standard.
Yeah.
The U.S. dollar has been the global reserve currency your whole life, Larry's whole life, my mom's whole life. Like, nobody knows anything but the dollar standard.
Right.
But this is a very short time, a period of history. Like, it would do well for people to go back and study history, especially some of our leaders, our congressmen, our people in the cabinet. They should study history and understand that it's not a given that the dollar is going to be the global reserve currency forever. In fact, the odds are stacked well against it for that to be, the reality. Will it continue for a while? Likely for a little while longer, but put in context, Larry, what we're talking about.
Well, I think we're losing it. And I think that ultimately, the way Gresham's law works, I mean, when everybody realizes they can never stop printing, and we're a long ways from that right now. I mean, all of us realize it. Some others realize it, gold holders realize it, Bitcoin holders realize it, but we're still a pretty small minority of the whole group. But this next print will make it more obvious to more people. And then the one after that is going to really blow your socks off because, we've seen the political response to this set of conditions, and it's to elect Madami, a socialist in New York City. And so, the blue team is going to come up with, stimmies and everything.
Well, it's clear that AOC and Mamdani are the future of that party.
Exactly. And
the Socialist Party now, and that's what it is.
And they think money grows on trees. And once they start to behave in that fashion, they will destroy the currency. It will be a certainty. And so, then you're at the stage. I mean, I've always said currency fails. This is where the power law gets broken to the upside. The power law is a very good model for predicting Bitcoin prices at 95% R squared. Everyone should read it. Fred Krueger, by the way, has a good book out, Bitcoin 1 Million. I highly recommend it. But the bottom line is that at some point in time, everyone's going to realize. And if you study hyperinflations, and hyperinflation is not my base case today, but it'll become my base case if blue team wins in 2028, I think. And hyperinflations occur when everyone realizes they can never stop printing money. And then what happens is you get a mass Gresham's law translation where everybody says, okay, yeah, you paid me $1, I'm going to spend it right now. And that's why in Weimar, Germany, the prices were changing every day. And so people want to get rid of the currency because they know it's worthless and they know it's going to zero. So,
it's so interesting. I had I don't know who it was, a conversation about someone who lived in Argentina in the days of the hyperinflation, and they said when we would go to dinner, you had to pay up front. You had to pay the bill up front before the dinner was delivered.
That does, yeah, if you went to lunch, you'd eat your lunch, you say, I'm going to get a cake or coffee afterwards, and they had the prices on a chalkboard, and they would just erase them and change the price know.
Yeah.
So.
And so this is what really helped me a lot. So I think this is a great segment. This isn't new, right?
No,
This has happened in
this has
history
happened.
many times before.
Yeah.
And we haven't learned about it because you mentioned Stephanie Kelton. That's the woman who says deficits don't exist, right?
They don't matter.
Proponent
We owe them to we owe it to ourselves, and you have to have deficits to stimulate the economy. I mean, but ask an Argentinian, ask a Venezuelan, ask a Zimbabwean, ask anybody in Nairobi.
Yeah.
It's also the entitlement economy. It's like, well, what do you mean I have to work for it?
Yeah.
Just give it to me.
Yeah. There's just a lot of broken thinking.
But Larry, you've studied the collapse of currencies, and you've talked about that quite a bit in your book and all that. So, people don't understand. Like, I'm not sitting here dooming, saying the dollar's dead. It's going to be.
No.
I'm just saying that, hey, it's not every single fiat currency has died.
Yeah, it's a tail case, but it's not. But
it's the history of the world.
Yeah, it's a tail case, but it's growing in probability. Let me say this: how am I wrong? How am I? And I hate being accused of being a doomer because I'm very optimistic about where we'll be after we return to sound money. Here's how I'm wrong. I'm wrong if the government suddenly gets responsible. And when I say that, of course, everyone laughs because the odds of that are quite low. But they're not zero. They're not zero. I mean, I've seen studies that show that the boomers are dying out and the voting bloc. I mean, right now they can't cut Social Security and Medicare because the boomer voting bloc's too big to prevent it. But what happens when there are fewer boomers and there are more millennials and, everyone else outvotes them and they say, hey, tough shit, Grandpa. We don't care. We're cutting your Social Security in half. We got to balance the budget, right? I mean, that could happen in the future.
Yeah.
I mean, there are things that, governments could get responsible. So I'm always, I'm long the monetary debasement trade, with nearly all my assets. But I'm always looking over my shoulder like, well, okay, is somebody around here getting responsible? Because if they are, my views on this would change somewhat.
Okay, cool. My next question is quite long. It's from X, but I think there's a short answer. I think this is a fun intermezzo. So this is the question. Did the deep state, through the Federal Reserve, organize an effort to redefine inflation as the normal increase in the cost of goods and services over time and infiltrate the major universities and get their economic departments to start pushing this agenda, creating an investment class oblivious to this reality and therefore making them tools of Big Brother as they suggest to clients how to invest, according to these rules, opening the door for Big Brother to rob us blind?
I would say, yeah. I mean, James, you know how I'm going to answer this. I mean, the answer is generally speaking, yes. I'm not sure it's the deep state. It's more just a lot of individual people doing self-interested things. I mean, whoever wrote that either has read my book or should read my book. And what you'll see is that what I think happened is that there was a very convenient marriage of three parties: academics, bankers, and government. That created the Federal Reserve and gave it a lot of power that it is badly abused. And, the government loved it because it allowed them to spend more than they could tax and they could hide the taxation in the form of inflation. The bankers loved it because the Fed made their game a heads we win, tails you lose game in the sense that, they could lend like crazy, get over leveraged, keep all the profits. And then when it blew up, they could socialize the losses and put it back to the government, or, they could finance World War I the way they did when, they were able to borrow at 3% and then buy Liberty bonds at 3.5%, but the government needs somebody to buy the bonds, and then the Keynesian academics loved it because they gave it all the imprimatur of, this is really sophisticated and knowledgeable, and all you regular people don't need to pay any attention to this. This monetary stuff is way over your head, and you need us to interpret everything for you and to run the Fed and to tell you how things are going to be. And, we get big speaking fees, and this is how Janet Yellen got paid $7 million, to speak in front of bankers who she enriched. So, there was kind of in my view, there's a tri-party deal that got made. And by the way, the cantillionaires loved it because, financiers and Wall Street loved it because they could also borrow very cheaply and then buy assets and become fabulously wealthy on a carry trade. So the system that we have benefited all of these other parties at the expense of the average American, the average world citizen. And, basically they don't suffer. They do bad shit in 08, they get bailed out, they get their bonuses. But guess what? Our grocery prices go up. Our gasoline prices go up. We pay for it. And because it's just a small thing, it's just inflation. It's only 7% a year. But as James pointed out earlier, take 7% compounded over a bunch of years, they're robbing you blind. So that's my view of what happened. I think my book lays that out pretty clearly.
It does. It lays out really clearly, and really the key component of all that is incentives, right? So the incentives are set up in a way that benefited a few and have hurt many, so that's just reality. We've seen it in emerging markets. We've watched this happen in emerging markets over the course of our careers and our lives, and it's nothing new. The separation of wealth is created by and
that's why there's this great wealth inequality, which is horrible. I mean, all of it. I mean, and that's why everything's so broken, and that's why so many of us are pushing back. And that's why, voting for sound money is not just a way, and buying these sound money assets, it's not just a way to get rich, which I think we will, but it's really probably, and I would argue even more importantly, it's a way to fix the damn world, because if we can deprive these assholes of all the power they have as a result of running this broken system, we can stop them from doing a lot of stupid shit, like wasting $8 trillion in the Middle East on wars. So it's really, when you invest in this stuff, you're making a vote that says, no, I don't like the way you guys are running the system. Fuck you. I'm going to buy other shit. Right.
Yeah. This is something I wanted to ask. So like, if the original purpose of Bitcoin was an FU, a middle finger to these people that created this abusive system that is not working for the vast majority of people, right? And the fact that you can own Bitcoin in self-custody gives everyone property rights over their wealth, their capital, brings individual freedom. Is this still here, or is it lost with the adoption of TradFi?
It's still there. I mean, some of the TradFi shit has made a lot of noise around it, and some of these TradFi people are very annoying. The Tom Lee and fucking Ethereum and the Solana ETF, and I mean, TradFi needs to die, and it will. But
so
go ahead.
How can people think through this TradFi adoption then? I think this is what people find hard. This is also what, for the people that view these people that are critical, they say, well, the original idea of Bitcoin was the self-sovereignty, etc. Everything against the banks, against TradFi, against the government. Now they're all adopting it. Well, how can people...
Don't forget, Bram. This is what people keep saying. Oh, BlackRock bought 50 million, 50 billion. Stop. It wasn't BlackRock. It was their portfolio managers buying it for their individual investors. Yeah. And the same thing with Harvard is buying for the endowment, but they're using that in the endowment. If you've got institutions and pension funds are buying it in order to, shore up their future liabilities for the people they owe money to. So it's not necessarily just institutions, these singular large players that are buying it. It's for the benefit of a lot of other people. And for those people, they're not comfortable yet going in and buying Bitcoin on exchange, taking off exchange, putting it in a cold storage, managing their keys and their seed phrases. They're just not comfortable with that yet. I think that something like ETF, well, that gets them a lot more, gets them closer to understanding it. And once they do understand it, it's like that's what will feed them into it. They'll go, oh, it's like the gateway to getting to, I want to own that myself. I want to put some in cold storage myself. I've seen people in my world who are not in finance do just that. What were you going to say, Larry?
I was going to say there's no way that we could have had it be adopted as global money, which is what I think it would become without it being integrated with TradFi. I mean, we needed TradFi to help go. I think where TradFi, one of the things TradFi doesn't understand, and one of the things some people might have to learn the hard way, is that not your keys, not your coins. And I'm not suggesting it's going to happen, but the difference between having native Bitcoin that you own and control and can take with you anywhere in the world, and owning IBIT, which you're one FDR 6102 executive action away from the Democrats. So President AOC says, hey, you know what? These guys who are sound money guys, they're ruining our beautiful fiat system, and they're evil. We need to tax the gains on Bitcoin and gold at 90%. And hey, let's not stop there. We need to actually seize all the Bitcoin and gold. So BlackRock, Fidelity, give everybody dollars and send those coins to the government. I'm not saying that's going to happen, but it's not impossible that it would happen. It happened in 1933. So, and that's where that will be the revenge of the true hardcore Bitcoiner versus TradFi, right? If it does happen.
Yeah. I fully agree with you. I'm just more saying, like, I see that people are watching people that talk about it like this. Like, in my mind, the only way for Bitcoin to become what we think it is through this, right? And like you said, there will be people in TradFi that will play fiat money fuckery type games with Bitcoin. But the whole point is that you do that once, right?
Bitcoin,
and you get burned.
Bitcoin doesn't care. I mean,
exactly.
And I think Bitcoin changes Bitcoin will change TradFi before TradFi.
They will have to bend to our rules. They don't know it yet, but they will.
Yeah. I think I would agree with you, actually. Maybe 2033, when Bitcoin is 1 million, right? And there's this crazy crypto anarchy weird corner with all these weird people that are together with their Bitcoin. They're going to be like, no, you're too rich. You need to you need to share, right? And could be AOC. But again, this is a great point. All this stuff has happened before. It's just a clear path. I think it's just hard for people to realize that we are in the midst of this, and that is also actually your opportunity, I would say. Like, you can step back, look at this bigger picture, look at history, read Larry's book, and then understand that there is one result, basically. And like Larry said, a non-zero chance there's financial austerity. Okay, but it's not even bigger than 1%, probably.
Well, it might be. We don't know. But the good news is on all of these topics, if you pay attention, you get clues as you go along, right? I mean, if they're going to 6102 this stuff, we'll hear about it before it happens.
Long before.
Yeah, and there'll be those of us who be out there on pods yelling and screaming, get your coins off the exchanges, get them out of the ETFs, right?
Yeah. All right. I want to ask you two last questions before we wrap up. We talked about the 4-year cycle being done. There are perpetual buyers. We'll still have like these psychological cycles. There's a lot of stuff happening in macro. We talked about how Jerome Powell is being replaced in May. What will happen then? Will that be a catalyst? Will there be someone that is like friendly to Trump, wants to help him with the midterms, liquidity, all these things? So that combined, what is your outlook for, let's say, the rest of this year and next year? We briefly touched upon it with terms of timeline, but there are some things happening that could be important.
Yeah, I think the rest of this year is definitely going to have some uncertainty. I mean, we only have 6 weeks left. 6 or 7 weeks left, and so there's going to be continued uncertainty. I think. I don't think we're going to get clarity this year. Next year, yes, we do get a Fed chair who is going to be favorable to this administration, and we're going to get liquidity. We're going to get liquidity in the form of QE, whether it's not QE or it's straight QE. We're going to get it because the system needs it. It's going to be ultra clear that the system needs it. Whether or not we have a sharp drawdown before that, that's up to the markets and market, kind of emotion. But I do believe that 2026, we're going to have continued liquidity until at least the midterms. And then we'll see what happens after that.
Yeah, I agree with James. They're going to run it hot. They're going to have a Fed chair I've already listened to Moran. I've listened to Warsh just had an editorial in the Wall Street Journal this morning where he talked about cutting interest rates and it was going to bring inflation down, which I found that hilarious. And they're just going to run it hot. I mean, and the bad news is, we're going to have a lot of inflation. The good news is the economy will probably hold together. And I mean, if they took rates down a lot, you might get a refi cycle in the housing market. I mean, a lot of people who want to move up in their houses, they can't because they're trapped in a 3% mortgage and they can't pay 6%. But if they drop rates enough, that'll change. So So my view is,
yeah, you'll definitely have asset inflation, in my opinion. I'm not sure how bad consumer inflation will be.
Yeah, there'll be a lag. There'll be a lag
really
on the consumer inflation because they're not going to probably directly print money with the cutting of rates, but the banks will eventually get out there and create more M2, and that'll lead to 3%. My view is this 3% trough that we've hit in inflation. That's the bottom. We're not going lower than that.
I think we're going to hover between 3 and 5% for a while, unless we get a boost of liquidity like Larry's talking about. Then all bets are off.
Yeah, no. If they really do it,
then you've got high inflation for a while.
They do more stimmies. I mean, here's an interesting thing. I mean, Trump talked about a $2,000 stimmy, right? Now, admittedly, only for houses with income below 100,000, but that would be inflationary, no doubt, if they do that. I mean, where's that money coming from? And then, by the way, if Trump loses at the Supreme Court on the tariff issue, and they have to give a lot of that tariff, income back, I mean, that's only going to make the deficit worse. So, to me, we've got inflation in our future. How much? How fast? How high? That depends on the policies. We just don't know. But but we do know the direction. Inflation is going up and to the right.
Yeah, and like you said, James, the between 3 and 5, that is of course eventually cumulative.
Yeah.
Right. So that will actually speed up the overall yearly inflation.
By the way, I don't really think the inflation today is 3. I mean, I think if you listen to most people, if you look at my personal experience, inflation is not running at 3%.
It's way above that, but that's what they tell you.
Yeah.
They'll keep telling you.
Exactly. And again, this is part of the big thesis, right? Even if they manage to get money from somewhere, it's already spent in some black hole that you never ever have seen the value of, right? Even when a child is born today in the US, there's already like $120,000 spent for them on something that they will never even see value of, right? This is, I think, what kind of orange pilled me even further is just that notion is that all that money is either gone or promised to someone who is not you, right? So, it's literally not there, but it's promised to a degree, or it just is created and then it disappears. Like no value is created, but anything that you hold of value, however many dollar units you have, right, that will be the base because more money units are created. Eventually, it's that simple, but it takes a while to, I think, understand. I want to ask you my last question. As I said before, you've really inspired me on my journey into Bitcoin and forming like this macro understanding and the thesis. And of course, the podcast is called Bitcoin for Millennials, but I think next to Millennials, also Gen Z, like we have the greatest upside potential for Bitcoin, especially because we have the most time, I think, hopefully. Is there any wisdom that you would like to share that helped you in your career that you think people could benefit from?
Go ahead, James.
Go ahead, Larry. Go ahead.
Somebody early in my career just told me, whatever job you have, just do it as best you can and try and be the best person who ever did that job, and it'll get noticed and you move ahead. And I think that's, blocking and tackling, it's ignored. And I know James was an athlete and was a pro athlete actually, and just doing the basics really well over and over again. I think that's what makes winners. And I would recommend anybody who's young, you've got to be self-disciplined. Be self-disciplined about your, what you eat, how much you drink, your working out, your job, etc., and take pride in all of that. And when you're young, you have the disadvantage of not knowing what you don't know, but you have the advantage of being incredibly strong with a ton of energy. And don't waste it. Get a lot of shit done. The other thing I would say is stack Bitcoin, because it will provide for you in your retirement. There's just no doubt about that.
Yeah, I'd say, one of the best pieces of advice I was ever given early in my career was surround yourself with people who are smarter than you. And I think I've been able to do that in the Bitcoin community, at least with, people like Larry and guys I've been hanging out with. It's really important to be able to learn from people and smarter often comes from experience. Okay, so wisdom comes from experience, not just straight intelligence. There are some very, very intelligent academics that are completely clueless about what's going on in the world.
That's for sure.
They don't have any real world experience. It's all theoretical, right?
Yeah.
And so experience brings wisdom. And then just have a longer term view. And like, I was so worried about the next day, like tomorrow, like, you know, and having these short term goals. Just set your long term goal, put your head down and start doing things to get toward that goal. And pick yourself up. You're gonna mess up. You're gonna stumble. You're gonna fall. You're gonna buy Bitcoin at the high. It's gonna come down in your face. That's okay. Just have a long-term outlook on what, you know.
Yeah, I would say treat your career, your body, yourself, everything the way like compound interest. You know, imagine if you got, you know, 1% richer every day, or 1% fitter every day, or 1% smarter every day. Those little 1%s, they add up. Do you know what I mean? So just
over the long term.
Yeah, just kind of keep trying on every, you know, grab a bunch of metrics that you think are important for your progress, and then chip away at those every single day. And it's very, I know it's very applicable actually in athletics, because, you know, if you're lifting weights as an example, you know, you just you keep using progressively more weight, and pretty soon what seemed really heavy in the beginning seems quite light. And it's just because you get stronger in the process, and that applies across a lot of things.
Yep.
Yeah.
Absolutely.
Awesome, guys. Well, thank you so much for your time and your wisdom. I really appreciate it, and I hope it's valuable for the people who listen to us. Buy the book.
Always selling.
The big print. Shout out to you guys. Yeah. Thank you so much. I truly appreciate it. Thank you.
Nice to be with you, Jim.
Nice to see you, Bram.
Likewise. I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, please like this video if you want to help shine a light on the message of Bitcoin, and subscribe to my channel to stay connected. I hope to see you for a next episode. Bye.